In the last 12 months, one company's stock climbed over 1,400%. Not a crypto token, not a speculative AI startup backed by venture capital in a dream, a 45-year-old chip manufacturer headquartered in Boise, Idaho, that most people couldn't name if you asked them on the street. That company is Micron Technology, ticker symbol MU. And in the last year, it quietly became one of the most important businesses on the planet. But here's what most people covering this story get wrong. They focus on the stock price. The real story isn't about the stock. It's about a tiny piece of technology that now sits at the center of every AI model you've ever used. And once you understand it, you'll never look at the AI trade the same way again. Let me give you the number that started this video. If you had put $10,000 into Micron shares just 1 year ago at roughly $69 a share, you would have approximately $146,000 today. That's not a typo. $136,000 in profit on a single boring memory stock. No options, no leverage, no crypto. Just shares in a company that makes chips most people have never heard of. But before you pull up a brokerage app, there's something you need to understand first. Because Micron has been here before. It has had moments exactly like this one. Extraordinary earnings, record margins, a stock price that looked unstoppable. And then it crashed. The question of whether history is about to repeat itself, that is the most important question in this entire story. And by the end of this video, you'll have the framework to answer it yourself. Here's what we're going to cover. First, what Micron actually makes and why it suddenly became indispensable to the AI industry. Because until you understand the product, none of the numbers make sense. Second, the financial story of the last 12 months, quarter by quarter. Because the numbers aren't just good, they're historically extraordinary, and you need to see them built up one at a time to understand what actually happened. And third, the investor question that matters most right now. Is this a once-in-a-decade opportunity, or are we standing at the top of a mountain that's about to give way? Let's start with the product. Most people think of memory in terms of their laptop's RAM or their phone's storage. Micron makes that too. But that's not what's driving this story. What's driving this story is something called high bandwidth memory, HBM. And to understand why it matters, you need to understand one thing about how AI models actually work. Where a data when your phone routes a query to a ChatGPT server, that process requires an enormous amount of data to move at extraordinary speed. From memory to processor and back, billions of times per second. The speed of that movement is called bandwidth. And for years, bandwidth was the hidden bottleneck limiting how powerful AI could get. Standard memory chips are connected to processors by electrical pathways. Think of them like highways. Those highways have a speed limit. The further the chip is from the processor, the slower the connection. HBM solved this by stacking multiple layers of memory chips directly on top of, or right next to, the AI processor itself, on the same physical package. Instead of a highway, you have a city block. Data barely has to travel. The result is memory that runs more than 10 times faster than standard DRAM, with a fraction of the energy cost. Every NVIDIA GPU depends on HBM. The H100, the Blackwell, the upcoming Vera Rubin. None of them work without it. No HBM, no AI chip. It's that simple. And here's the strategic reality. There are exactly 3 companies in the world that can make HBM at meaningful scale. Samsung, SK Hynix, and Micron. That's it. A global AI infrastructure build-out worth hundreds of billions of dollars, running entirely through 3 suppliers. And for most of 2023 and 2024, Micron was the number 3 player. SK Hynix had roughly 70% of NVIDIA's HBM supply. Micron was catching up. Then 2 things happened simultaneously. Micron's engineering team cracked HBM4, the next generation of the technology, using what's called 1-beta DRAM, their most advanced manufacturing node. Their HBM4 delivers 2.3 times the bandwidth of the previous generation, with more than 20% better power efficiency. That's not an incremental improvement, that's a generational leap. And at exactly the same moment, AI demand exploded past anything Wall Street's models had been projecting. By early 2026, Micron's entire HBM output for the year was already sold. Not committed, not reserved, sold, under binding multi-year contracts to the biggest technology companies in the world. The stage was set. Now let's look at what happened to the numbers. Let's build this story the way it actually happened, quarter by quarter, because watching these numbers compound is the only way to understand the scale of what Micron just did. May 2025, fiscal Q3. Micron reports $9.3 billion in revenue, a solid quarter, growing. Gross margins at 37.7%, the kind of results that make analysts nod approvingly and move on. August 2025, Q4, $11.3 billion, a step up. Gross margins now 44.7%. Things are clearly accelerating. A few investors start paying closer attention. November 2025, Q1 of fiscal 2026, $13.6 billion, record revenue at the time. CEO Sanjay Mehrotra calls it, quote, record revenue and significant margin expansion. Micron is positioned as an essential AI enabler. Gross margins, 56%. The stock is moving. But the real move hasn't happened yet. February 2026, Q2, $23.9 billion in a single quarter. That's not an acceleration, that's a different company. Gross margins hit 74.4%. Operating cash flow in one quarter, $11.9 billion. The stock gaps higher. Analysts scramble to revise their models upward. Nobody has a prior reference point for these numbers from a memory company. And then came June 24, 2026. Micron's fiscal Q3 results. $41.46 billion in revenue. Net income of $28.24 billion. Gross margins of 84.6%. Operating margin, 80.4%. Read those numbers one more time. 84.6% gross margin. To put that in context, Apple, one of the most profitable companies in human history, operates at roughly 45% gross margin. Micron just reported nearly double that. For the first 9 months of fiscal 2026, Micron generated $47.3 billion in net income. That is more profit in 9 months than Alphabet, Google's parent company, generated in all of 2023. And Micron's guidance for Q4? $50 billion in revenue. Let that land for a moment. 1 year ago, Micron was a $9 billion per quarter business. By the time this video is posted, it will be guiding toward a $50 billion quarter. What caused this wasn't luck. It wasn't just demand. It was a specific strategic move that Sanjay Mehrotra described as transformational strategic customer agreements. Multi-year, binding supply contracts, negotiated directly with the largest AI companies on the planet: Amazon, Microsoft, Google, Meta, Oracle. These companies looked at the AI infrastructure build-out ahead of them, looked at how much HBM they would need over the next several years, and they locked up supply in advance. Not open purchase orders, binding contracts. And then, just 2 days before the Q3 earnings report, Micron announced one more agreement that nobody saw coming. On June 22nd, Micron signed a strategic partnership with Anthropic, the AI company behind Claude. Anthropic named Micron its primary supplier of memory and storage for the next generation of its AI models. The two companies will co-design HBM and storage specifically optimized for Anthropic's workloads. And Micron made a direct investment in Anthropic's Series H financing round. That agreement was Micron's 16th long-term supply contract signed with major customers. 16 contracts, backed by approximately $22 billion in upfront commitments. When you're one of 3 suppliers in the world for a product every AI company needs, and you have 16 binding multi-year contracts in place backed by $22 billion in commitments, your margins don't just improve, they transform. Now let's talk about what all of this meant for investors. 12 months ago, Micron's stock was trading at roughly $69 a share. The AI trade was already running hot. NVIDIA had been on an extraordinary run. But Micron wasn't getting the same attention. Most of Wall Street still saw it as a cyclical memory company, something you trade, not something you hold. The consensus view was cautious. Between June 2025 and the post-earnings peak in late June 2026, MU rose from $69 to over $1,255 per share. That is an over 1,400% gain in 12 months. And as of this video, after a roughly 20% pullback from that peak, the stock is trading around $1,000. The investors who identified this trade early weren't necessarily smarter than everyone else. They were asking a different question. NVIDIA is obvious. Everyone knows NVIDIA. So if NVIDIA is already priced for perfection, where else does the AI trade go? The answer, for a certain category of investor, was picks and shovels. During the California gold rush of 1849, the miners who found gold got rich, and then mostly lost it when the rush ended. But the people who sold picks, shovels, and denim jeans to the miners made steady, reliable money, regardless of whether any individual miner struck gold or not. The demand for tools was guaranteed by the existence of the rush itself. The AI boom has a picks and shovels layer. NVIDIA makes the processor, the gold miner. But NVIDIA can't ship a single chip without HBM memory. Every GPU that goes into a data center carries HBM from one of three companies. You can't swap it out. You can't substitute for it. You can't build around it. Micron was the US-based pick and shovel play, with CHIPS Act protection, a leading-edge manufacturing roadmap, and a $250 billion domestic expansion commitment through 2035. For investors thinking one layer deeper than the obvious trade, it checked every box. That's the thinking that generated a 1,400% return in 12 months on what looked, to most observers, like a boring old memory company. Here's where the story gets complicated. And this section is the reason this channel exists. Because anyone can tell you the numbers that already happened. What's harder and more valuable is helping you think clearly about what comes next. Memory is one of the most cyclical industries ever created. It has boom and bust cycles that run with almost mechanical regularity. In 2017, the last great memory supercycle hit. Micron's stock tripled. Margins expanded. Headlines were written. And then, in 2018 and 2019, the stock crashed 60%. Not because the company did anything wrong, because all three manufacturers saw the high margins, ramped production simultaneously, flooded the market, and prices collapsed. So before we talk about whether Micron is a buy today, we need to ask, is something structurally different this time? Or are we watching the same movie with different actors? The bull case, why this time might be different, rests on four pillars. First, HBM is technically much harder to manufacture than commodity DRAM. You cannot simply build more factories and flood the market. The stacking process requires specialized equipment, years of process development, and intellectual property that takes a decade to accumulate. Supply constraints are real, durable, and structural. Second, those strategic customer agreements provide multi-year revenue visibility that commodity memory has never had. These aren't handshake deals, they're binding contracts. Micron's 2026 HBM production was sold before it was made. That is not a cyclical business dynamic. That's a contracted one. Third, the underlying demand driver shows no sign of slowing. The five largest technology companies in the world are projected to spend over $600 billion combined on AI infrastructure in 2026 alone. And Micron's management has stated they expect the memory market to remain tight through at least 2027. Fourth, and this is new, Micron is no longer just an AI data center story. In late June and early July 2026, Micron signed long-term strategic supply agreements with both General Motors and Ford. memory and storage for next-generation vehicles. The automotive AI wave is just beginning, and Micron just locked up two of the three largest U.S. automakers as long-term customers. That build-out has years left to run, and every dollar of it flows through memory. But the bear case is equally serious, and you'd be doing yourself a disservice to ignore it. Samsung and SK Hynix are not standing still. Both companies are aggressively ramping HBM4 production. When all three suppliers expand capacity simultaneously to chase the same demand signal, which is exactly what's happening right now, the classic memory glut eventually follows. It always has. Micron's gross margins of 84.6% are historically unprecedented for a hardware company. Margins like that attract capital, they attract competition, and they compress. The question isn't whether the margins will fall, they will. The question is, how fast and from what level? And then there's a risk that emerged just days before this script was written. On June 25, 2026, a class-action antitrust lawsuit was filed in the U.S. District Court of Northern California. The complaint names Samsung, SK Hynix, and Micron as what it calls three oligopolists who have allegedly colluded since 2022 to fix the supply and price of conventional DRAM. The claim is specific and pointed. The lawsuit alleges that all three companies simultaneously cut production of standard DDR3 and DDR4 memory, the kind that goes in your PC, your laptop, your gaming console, while pivoting to high-margin HBM for AI data centers. Not because the market forced them to, but because, as the complaint puts it, they acted in concert. None of the three used the other's retreat to expand and win customers. All three pulled back together. The result, the lawsuit claims, is a 700% price increase in conventional DRAM over 4 years. Apple called it the most dramatic component price increase it had ever seen. Nintendo, Sony, and Microsoft all raised console prices, citing memory costs. Gaming PCs got more expensive. Laptops got more expensive. And Micron, at the height of its profitability, quietly shut down Crucial, its consumer memory brand, the one aimed at everyday customers, at, as the lawsuit puts it, the most profitable price point in its history. Now, Micron hasn't responded publicly, and they'll almost certainly argue that AI demand alone explains the shift, that they were simply following a rational business decision, not coordinating with competitors. The case is early, and class-action antitrust suits are notoriously difficult to prove and slow to resolve.
But here's the investor reality. This is the kind of headline that can rattle a stock trading at historically unprecedented margins. If a court were to find merit in these claims, or if regulators were to open an investigation, the regulatory and reputational risk is not trivial. Smart investors don't ignore legal risk just because the earnings look perfect. Here's the framework to hold all of this together. The first rule of cyclical investing is deceptively simple. You buy cyclicals when they look terrible, and everyone is ignoring them. You sell when they look magnificent, and everyone is talking about them. 12 months ago, Micron was being ignored. Today, Micron is being discussed on every financial news network, every investment podcast, and apparently on YouTube channels about business documentaries. That doesn't make it wrong to own, but it means the risk-reward has fundamentally shifted. The person who bought at $69 had asymmetric upside. The person buying today at over $1,000 a share, even after the recent pullback from the $1,255 peak, has a very different equation to solve. So what's the investing lesson from Micron's last 12 months? It's not buy memory stocks. That's the surface-level takeaway, and by the time you're applying it, you're usually too late. The real lesson is the picks and shovels framework, and more specifically, how to apply it before the gold rush starts, not during it. When a major technology shift begins, the obvious winners get priced almost immediately. The market finds NVIDIA fast. It finds the cloud providers fast. It finds the AI software companies fast. Because those are the names people already know, and they're easy to understand. What the market is slower to find are the companies one layer deeper,
The component suppliers, the equipment manufacturers, the infrastructure enablers, the businesses that every winner in the space requires, but nobody is making documentaries about yet. Micron in 2024 was that company, hidden in plain sight, essential to everything, and priced as though it was just a memory manufacturer. The question worth sitting with now isn't whether you should have bought Micron a year ago. That trade is done. The question is, what's the Micron of the next phase? AI is moving into physical environments, robotics, autonomous vehicles, edge computing, industrial automation. Micron just signed deals with Ford and GM to supply the memory for next-generation vehicles. That story is just beginning. But the component suppliers for the robotics wave, the edge AI wave, the autonomous vehicle wave, most of those are probably trading at prices that look perfectly ordinary right now, because the story hasn't found them yet. That's the analysis this channel is built around. Finding the business story one layer deeper than the headline. Understanding what a company actually makes, who needs it, and what it's worth before everyone agrees on the answer.
Micron's story is one of the clearest examples in recent memory of how understanding a business, really understanding what it makes and who depends on it, can surface an investment before the crowd arrives. A 45-year-old memory company in Boise, Idaho, one of 3 suppliers of a component nobody outside the industry had heard of, 16 binding contracts with AI companies, automakers, and now Anthropic itself, and a stock that returned over 1,400% in 12 months to the investors paying close enough attention. If this kind of analysis is useful to you, the business story, the real financial picture, and the investing lesson you can actually apply, like, share, and subscribe to the channel. Every episode of Capital Autopsy follows the same format. We open the company up, we look at what's actually inside, and we tell you what it means for your money. The next autopsy is already in progress.